Hello, everyone, and welcome to this edition of Macro Minutes. I'm Jason Daw, the head of North America Rate Strategy, and your host for this episode. Today, we're going to examine how global interest rate cycles are evolving and what that means for markets heading into 2026. We'll look across the US, Canada, Europe, and Asia Pacific with insights from our regional experts like Gwinn, Simon Deeley, Peter Schaffrik, and Robert Thompson to understand the factors influencing central bank decisions, the forces shaping yield curves, and how investors are interpreting signals from policy, growth, and fiscal dynamics. The conversation brings together regional perspectives to frame where the debate on rates stands now and what to watch next. So to kick off today's episode, we're going to start in the US, and there's a lot of uncertainty surrounding the Fed next year. Hawks and doves on the FOMC have never sounded more divided than they are right now, and the lack of timely macroeconomic data certainly hasn't made resolving those differences any easier. So Blake, how are you thinking about the Fed in 2026? How much are they cutting and when? And is the new Fed chair going to shake things up?
Yeah, thanks, Jason. So I think one thing you've rightly identified there is that the last few months, it really has seemed like we are entering a bit of a new era for the Fed, where more specifically, we're moving away from these very well telegraphed, high consensus decisions and moving to something where you've got a much more divided committee. Every meeting's essentially a toss up until the weeks or even days before the meeting. And also, you're picking up a lot of dissent. And I think that's a function of the fact that the data right now really is, kind of splitting the committee, pulling both sides of the dual mandate in opposite directions. And that's why I think you're seeing a lot of these bigger rifts. Given the fact that we have a somewhat sideways economic outlook for 2026, continued stagflationary light type of data, you've got Trump's coming appointment of a new Fed chair. And I think you also have what's almost certainly going to be continued White House pressure on the Fed by any means possible. It does seem like this new era of FOMC division and uncertainty around their decision-making process is really probably going to continue into next year. So what does all that mean in terms of our 2026 Fed call? I think each additional cut from here is going to be increasingly hard fought. Every 25 basis points the Fed's going to cut is going further into that neutral range. You're going to see the Hawks getting louder and louder. And I think with the current divide on the committee, they really only have to swing one or two of the centrists to capture a majority. So all told, we have only two more cuts from here. That's the terminal rate stopping in the 325 to 350 range, definitely short of the 3% that's currently priced in the market. And after that, I have them on hold for the rest of the year. I did want to mention this possibility of a Trump shakeup. I think the impact of that has been perhaps a bit overdone. Powell is already on the dovish side of the committee, so if you replace him with another dove, it's not really going to swing the scales in a major way. And as far as delivering some of the uber dovish outcomes, if you want to call them that, I would point to the outlook that's been advocated by Mirren. I really don't think a new chair is going to have the numbers to deliver those types of outcomes. So I really think the primary impact of this new Fed chair coming in is really just going to be an exaggeration of those themes that we already mentioned, which is increased variation in Fed speak, more dissents, and more uncertainty around each meeting. But I don't think they're really going to be able to pull the needle in a much more dovish direction single-handedly without the rest of the committee.
Okay, thanks, Blake. That's obviously going to be a major theme for 2026 as far as what the Fed does and how that impacts risk assets. Now, Treasury yields, they've been broadly trending lower over the course of 2025, but whether that move continues in 2026 is an open question. And one of the reasons that this past year ended up being a strong one for the Treasury market was a shift to a more dovish Fed outlook and lack of any major developments on the supply front. So Blake, where do you see Treasury yields and curves going in 2026 and why? Are we at a risk of a bearish supply-demand narrative flaring back up?
Overall, I think that bullish move and the steepening that we saw in 2025, that has largely leveled out. The reality is that the Fed call I just outlined, it really isn't far enough off of market pricing or the consensus to really be a major bear driver in 2026. So I do think it's enough if we do see that the Fed stopping short as we expect. I do think it's enough to shift us back into the yield ranges that we saw before the negative NFP revisions in mid-2025 that really got the Fed turning dovish, marked most notably by Powell at Jackson Hole. But I don't think it's really enough to argue for this large core short rate position into 2026. I lean towards higher yields. I probably I'm modestly biased towards flatter curves, perhaps just as much for the positive carry as for expectations of a Fed repricing in the front end. But again, I don't think we're going to see new breakouts returning to those high yields that we've already seen in the cycle. Overall, I think 2026 likely to be a fairly range-bound environment for treasuries. As I just noted, I think it's going to really be more about tactical trading. It's going to be more about finding carry than really putting on large directional positions on either duration or curve. I think that's consistent with this relatively sideways economic outlook we have, where you've got growth that's tepid but still positive. You've got labor markets still sluggish, but not really hitting some stall speed or not seeing this non-linear deterioration that I think the Fed's worried about. And you've got inflation that's annoyingly above target for the Fed, but it isn't really showing signs of any kind of meaningful acceleration. You did mention the supply outlook, and I don't really consider myself a deficit hawk on the side, but I don't think we're really expecting a meaningful rise in term premium this year, but it is one area where I could potentially see some temporary upward yield shocks. We have penciled in some increases in coupon auction sizes for August of next year. There could certainly be some angst around the start of those increases. We saw something like that happen in late 2023, the last time the Treasury embarked on increases in auction sizes. You could also see potentially some attempt at a stimulus check into the 2026 midterm elections. We've heard Trump administration talking about these tariff rebates. You could see some headlines around tariff revenues potentially getting cut off or even reversed around the Supreme Court decision that's due on IEPA. Or you can even see some resurgence of these de-dollarization concerns that picked up around Liberation Day in 2025. But again, I don't really have a fundamentally bearish view around these things. I think we could see temporary flare-ups. Definitely something I'm looking at as a bearish risk in 2026, but not really part of our fundamental core outlook. The second bearish risk I'd really be looking at is around the inflation outlook. Thus far, tips break-evens, demand for inflation protection, very, very tame throughout 2025. But I could see a scenario where some stew of easy fiscal policy, the already delivered Fed cuts, fading of uncertainty around the trade war that really spiked around Liberation Day, some continued gradual pass-through of tariff costs, all these concerns about Fed independence, and lastly, I think some lingering effects around immigration policies. You could see all of that stuff combining together and putting some upward pressure on inflation expectations. So that's another bearish risk that we'd be on the lookout for. As far as the bullish risk to rates, pretty straightforward. I think the first is we're just wrong about the nature of the labor market right now. We are hitting some type of stall speed, and we get into a position where the Fed is required to cut well past that neutral rate, but actually into accommodative territory. And then the second, I think, is really more market-based. It's some potential unwind of this AI, a CapEx trade that we've seen in risk assets that would drive some type of risk-off flow into treasuries. So those are the two primary bullish risks. I would say the first one around the labor markets, I put a fairly low probability on. And the second one, I'm pretty agnostic. I'm not really an expert in AI, certainly when it comes to timing any type of repricing like that. But those are the two of the risks that we are looking at in the bullish direction for next year.
Thanks a lot, Blake. Moving on to Canada. Canada is facing some new realities: population growth shock, ongoing challenges from low business investment and productivity, and some new opportunities on the fiscal policy front. Simon, can you elaborate on the growth outlook for Canada?
Yeah, definitely. There's new aspects going on in the Canadian economy. Population growth has gone from 2 to 3% in recent years to about flat this year, and that's where we expect it going forward. This has reduced the potential growth or steady state growth run rate for the economy, a 0 to 1% range from above 2%. And this is important because the Bank of Canada works off of this framework where they look at how actual growth is relative to that potential growth number for determining policy in the future. And this current environment has made GDP data especially hard to interpret because of the population side and also the transition to the new trade environment given all the trade shocks from the US. For Q3, for example, we had very strong headline growth, well above consensus at 2.6% annualized, but the details saw net trade very high due to reduced imports and final domestic demand and consumption actually flat to small negative in the quarter. And as well, there were some pretty sizable back revisions upward in general and including for non-residential investment. So while this could make productivity look a bit better, the general trend has been pretty weak productivity and investment numbers relative to the US. Now, going forward, we do expect growth to move above the new low trend rate. So, for example, in 2026, we do see growth in the 1.5% to 2.2% annualized range in each quarter of 2026. So this should reduce economic slack and even eliminate it over the course of the year. Fiscal, as Jason, you mentioned in the preamble there, will be a big factor. We've seen change in government, investment-heavy budget, and we do expect it to add about 0.3 percentage points to growth in 2026 as a whole. It could be higher, but we're taking kind of a wait-and-see approach to that fiscal add.
So I'm just curious now how this all translates into the outlook for the Bank of Canada. They were on hold for a large portion of the year. They moved off the sidelines, cut in September and October, but they seem unwilling to cut further unless growth is weaker than forecast. So What are you thinking on the outlook for the Bank of Canada in 2026?
In October, they did introduce a conditional pause to the overnight rate at 225, which solidified our view going forward that they will keep it there through the end of 2026. And this is the lower end of their neutral range. So 2.25 to 3.25 is their neutral range, and they're at the bottom right now. There's certainly two-sided risks to the bank. If we get a weak economy, labor market down, and a downward inflation trajectory, we certainly could see further cuts. But we don't see that as very likely. It's the lower probability of the two possible outcomes. More likely is that we get an improving growth profile that we mentioned earlier, and that leads to possible hikes even as soon as late 2026. In that scenario, inflation likely holds around 2% or even slightly above. It's worth noting as well a little bit on the balance sheet side, the bank ended quantitative tightening in early 2025. They started doing term repo since then and will be introducing regular bill purchases starting December. However, bond purchases are not likely until 2027. So on the balance sheet side, they're a little bit ahead of where the Fed is. But on the bond purchases, there's still quite a ways to go.
The bond market was a tricky animal in 2025. We had 2-year yields almost 100 basis points lower, but 10-year yields were unchanged so far, and 30-year yields are a little bit higher and curves a bit steeper. So what is the macro Bank of Canada outlook and issuance outlooks when we combine all those? What does that mean for Canadian bonds and the yield curve in 2026?
Yeah, it's certainly an interesting environment. Monetary policy is typically the usual driver for yields and curves. Given that we have a flat profile in 2026, it may be less so, but the pricing will still shift. And so you do see some impact from monetary policy pricing, at least. And we do think some expected pricing of hikes in late 2026. It should see some flattening of the curve, especially on the 2s5 side. What we saw in 2025 was a bit of term premium related steepening. This is especially at the back end of the curve, 10s, 30s, for example. And that's another possible factor in 2026, as we do have 30-year issuance steady, while shorter tenors will see a little bit lower issuance. Overall, bond issuance will still be quite high. And as I mentioned, the bank will not be buying any bonds still. So issuance net of Bank of Canada purchases will remain quite elevated. And as well, Government of Canada bonds are typically impacted pretty heavily by moves in the Treasury market. And this will especially be the case with a strong monetary policy driver. And so that'll be worth watching as well if the upward pressure comes from the Treasury side. Overall, we do think the Government of Canada's can outperform Treasuries as U.S. cuts are priced out, especially in the belly of the curve, so around the 5-year sector.
Thank you. And on our world tour on this podcast, we're going to now move across the pond. Peter, let's start in the Euro area and the ECB. Going into 2025, you were arguing for less cuts than the market was pricing at the time. The ECB, they did one more than you thought, but by and large, less than what the market was calling for. And going into 2026, the market's still pricing some residual chance of rate cuts. What do you expect for next year?
Yeah, thank you, Jason. So look, trend growth has come down, but actual growth is probably going to end up north of where the reduced trend is. Unemployment is still relatively low. Wage growth is probably still slightly elevated. And yes, inflation is at the ECB's target, but they've also cut rates quite aggressively already to 2%. So as you were saying, the market is still expecting residual rate cuts going into next year. And frankly, I have difficulty seeing that coming to fruition. You already see sort of a little bit like in the Fed, there's a quite strongly divided governing council. And the ECB has now communicated that they are, as they say, in a good place. So barring any macroeconomic shock or any significant disinflationary forces that I don't foresee, I think the call for the ECB to move to a more balanced approach in their official outlook as well is very likely. And in fact, when you look at the actual outturn of the data compared to their forecasts, we reckon that in the December meeting, probably going to upgrade their forecasts anyway. So going into 26 then, as we get the fiscal stimulus out of Germany, the economy is probably going to do okay. I mean, the forward-looking indicators look like that. I reckon what's going to happen is that the market is going to realize, well, actually, they're done. We have to price out these residual rate cuts. And in fact, if I give you one sort of more wonky reason as well, is we also see that the money market curve can probably steepen a little, not only for these macro reasons, but probably also for some technical reasons, because in contrast to the Fed, the ECB is following a different strategy of how they provide their reserves. And we're probably getting close to the point where the reserve provision through the QE program has been running its course and the bond portfolio is getting smaller and smaller. and then the recourse of the market will come through the repos, and the repo rate is 15 basis points above the deposit rate. And so I reckon that we get more and more as the year progresses into an environment where not only does the macroeconomic outlook say, all right, these guys are done, and maybe the next move is even up, and we go from pricing small cuts to small hikes. Also, for technical reasons, the implied market rates will probably start to come from quite a bit below the deposit rate towards the depot rate, and then maybe at some point in 27 even above it. So all of these reasons for me argue that there's very little juice left at the front end, quite to the contrast.
Okay, that's an interesting take, Peter. Now, the UK is a different animal, it appears. Growth is probably even lower than in the euro area, yet the Bank of England rate is still almost double the ECB at 4%. And you changed your call for the BOE recently to 3 more cuts from here. What made you do that? And isn't the 3.25 ending point still quite high in relative terms?
If I start at the beginning, yes, indeed, we think the UK is a different animal, as you said. So I mean, the starting point is very similar, actually. I mean, our trend growth rate has come down, our productivity has declined. But in contrast to the euro area, we don't get a fiscal stimulus. We'll probably get some fiscal retrenchment. And the growth outturn is probably going to be below the trend number. Unemployment has been rising and wage growth has been falling. And the Bank of England has been very adamant over the last year or so that they want to keep rates high until inflation comes down, and particularly intrinsic inflation, like the service inflation, comes down, which is closely linked to wages. So what we reckon is going to happen is inflation is going to come down, growth is going to be weakish, and even if the labor market starts to recover, it will take some time until the slack that has built up is being reduced. So in that environment, we think that the bank, which is one of the last central banks that's running restrictive policy, can ease policy quite a bit. And the market has been scarred a little, and they will find it very difficult that before the Bank of England gives the all thumbs up to price aggressive rate cuts. But we think that's going to come. So we actually think the 3.25, and that probably goes to the last part of your question, that we are forecasting, which is 25 basis points below what the forwards are currently implying, is not that aggressive. When you take everything into account, I can even see an environment where there's a point over the course of 26 where the market is maybe even pricing something below that. So we actually think that the UK front end is one of the few places where we are really optimistic that positive returns can be achieved.
So where does this leave you in terms of bond yields? I presume you expect the UK to outperform in relative terms, but where do you see absolute yields? And also, does the sharp curve steepening in the euro market continue?
I mean, despite all the idiosyncratic things that are happening, the overall outlook for yields is still determined to a great deal from the treasury market. But as Blake was saying earlier, we as a house have not necessarily a bullish view. And that obviously resonates with what I said about the ECB. So when you think about the two largest central banks not really delivering any stimulus for the bond market relative to the forwards, that will make it difficult, I would argue, for bond yields to come down. So we actually have a fairly negative view for bond yields in particular. And on top of the lack of stimulus for bond yields to come down from the short end of the curve, I would argue that the steepening that we've seen in the euro curve probably has still further to run. So when you think about it, where did it come from in the first place? The curve started the year 25 from a very, very flat place, and not only because front-end rates were high, but also and because structurally the ECB was still holding this very large QE portfolio that had depressed term premia. And as they were unwinding that, and as we obviously also have our own fiscal worries here, be it France, be it some of the Southern Europeans, or be it the fiscal stimulus that's going to come from Germany, we have seen that term premia going up. Now, when you analyze it where it is currently relative to, let's say, the pre-COVID European debt crisis and GFC period, it is still way lower than where it used to be 25 years ago. So we think there's certainly legs in the curve steepening theme as all of these forces just continue that were in place from 25, continue into 26. And on top of that comes an extra force that is through the Dutch pension fund reform, which in a nutshell will probably lead to these pension funds shifting their assets out of long-dated fixed income into something else. So that should probably also give you some pressure there. So we have termed this the inverse conundrum, whereas the front end, even though the central bank were cutting rates, didn't really lead to any lower long-term rates. And I think that's going to continue. So in absolute terms, therefore, I find it really difficult to see how the European bond markets, that includes the UK, can deliver positive total returns in absolute terms. Now, in relative terms, I think you're absolutely right. We like the UK. We like it a lot, in fact. So in cross-market trades, we like to overweight the UK. So if you want to build a portfolio where you take some long duration, we really recommend it to take it in the UK relative to, let's say, the euro area. And in the front end of the sterling curve, we even think some absolute gains can be achieved for all the reasons I just outlined in the question about the Bank of England. So it's really it's a difference of relative versus absolute performance. And there we think the UK is probably going to do quite well.
Thanks, Peter, for the insights on the UK and the euro area. And the last stop on our world tour is Australia. And Rob, we've seen inflation pick up there sharply over the last couple of monthly and quarterly releases. Does this mean labor market considerations take a backseat and the RBA may need to look at hiking rates next year?
Hi, Jason. The pickup in the last couple of quarterly inflation reports and monthly has indeed overshadowed labour market considerations recently. But for extra context, there's largely because the labour market picture doesn't look all that bad. If employment was truly struggling, we might not be discussing openly rate hikes at all. But stepping back into the data a little to set the scene first, the unemployment rate's been gradually creeping up towards 4.25%, 4.5%, from a base of 3.5% in late 22. But the most recent October reading, it dipped again from 4.5% to 4.3%. And we're not expecting it to reach much above 4.5% next year either. So given 4.5% might still be sub Nauru, our focus thus swings pretty quickly back to the inflation side of the bank's mandate. And here we're seeing a problematic picture take shape. The third quarter inflation report saw trimmed mean inflation lift to 3%, well above market expectations and our own. And in the more recent October monthly report, it looked even worse, running at 3.3% year on year. Earlier in the year, inflation looked to be fading, with the second quarter trim to mean down to 2.7%, and the RBA's 2.5% midpoint target coming into sight. Instead, we're now in a position where inflation's back to 3% plus. Supply side of the economy simply isn't able to keep up with the pickup coming through on the demand side. And with the RBA cutting its potential growth assumptions to only around 2% yearly, against a backdrop of low productivity growth and high unit labor costs, it's looking pretty tough. A lot of concern we have with inflation is also in the composition. It's skewed towards services, some particular items which tend to lead, like housing costs, which seem to be picking up again. And given we also see a broadening out of private demand, leading to overall activity growth in Australia of well over 2% next calendar year, it's difficult to see core inflation falling back towards 2.5% anytime soon. So returning to the main question, will the RBA need to look at hiking rates next year? Our base case is the bank leaves them unchanged through 26, but we'd put the odds of at least one hike at around the 25% mark, so certainly not immaterial. Our main reasons for pouring some cold water on hikes would be that, one, the cash rate is probably already a bit on the restrictive side at 3.6%, and two, the RBA has preferred the last couple of years to take a patient, smooth approach to the rate cycle compared to lots of other global central banks. It's tolerated some high short-term inflation to protect the labour market. And we suspect much of this core DNA will remain in their decision-making going forward, but the odds of a hike are clearly above those of a cut, and that's a big shift from us over the last couple of months. So every monthly and quarterly print on inflation from here is going to be super sensitive for markets, and if inflation doesn't slow materially over the next 3 to 6 months, then a resumption of the hiking cycle will likely become the base case.
Now, given the shifting in data, Australian bonds have underperformed most other developed bond markets by a considerable margin over the last few months. At what point are they wide enough to warrant another look from global investors?
Great question. Thanks, Jason. It's been a rough ride for investors in Aussie bonds lately. The benchmark 10-year spread over treasuries has jumped from minus 20 basis points back in June to plus 20 at the start of November, now over 50 basis points. So when's it wide enough? Well, honestly, we think there's more than enough value in there already for investors. The main issue is that there's no imminent catalyst from the Aussie side on the calendar to allow this kind of trade to perform. So against the US, it's therefore much more around our view that US rates should sell off, given we think the Fed is priced for too much, as Blake has already told us all about. And if we break down the Aussie-US 10-year spread into real yield versus inflation expectations, it also doesn't seem quite right to us that Aussie real yields, 40 basis points over Treasury real yields. Quite apart from anything else, the Australian Commonwealth fiscal story is far less intimidating than the US federal equivalent, which suggests that Australian real yields should be materially lower or even below their US equivalents. Less from a fundamental point of view and more from a market's perspective on timing, it might be a little tough to see performance into the back end of this calendar year from Aussie bonds, and instead more likely that could emerge as the market reopens, so to speak, in January, particularly as the traditional kangaroo issuance season hots up, which is the rush of offshore issuers hitting the Aussie dollar market for funding at the start of every new calendar year. That's the next catalyst, timing-wise, when you might see enough liquidity return to the market to actually see the market have some relative performance emerging.
Finally, Rob, the Australian yield curve has been consistently flattening since August. Is this trend likely to continue or stall? And will domestic considerations be the bigger driver or the always high correlation with U.S. Treasuries?
We tend towards the view that the curve can resume flattening through 2026. On the technical side first, we note our cash rate is at 3.6% and there's no easing pricing anymore, so our 70 basis points 3s, 10s futures curve is fairly steep, and various key longer end yields like 30-year bonds and 5-year forward interest rate swaps are above key 5% level, which will likely keep marginal flattening pressure on as investors look there for carry rather than the more volatile front end. One final point, there's likely to be more movement in the Fed story next year than the RBA story. That will be primarily hitching a ride on Blake's view, looking for marginal flattening driven by the Aussie correlation with the Treasury curve at the forefront and punctuated with occasional domestic-led movements, particularly as we get fresh inflation data coming through.
Thank you for joining Macro Minutes. 2025 was a wild ride in macro and markets, and 2026 will surely see some curveballs. As the situation evolves, please reach out to us directly or via your RBC sales representative for further insights. This episode was recorded on December 1st, 2025, and for the Australia portion on December the 3rd, 2025. Listen and subscribe to Macro Minutes on Apple Podcasts, Spotify, or wherever you listen to your podcast. If you enjoyed the episode, please leave us a review and share the podcast with others.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.